Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion, the CEO and founder of Flying V, Deep Knowledge Investing's digital marketing partner. Robb, how are you today?
Doing great, Gary. Happy Monday. Hope your week is off to a great start. And as always, it's a pleasure to be here for this week's five things.
Yeah,
Any
thanks.
initial thoughts you have?
Yeah, I'm the only person not upset today, apparently. Every comment I saw on Twitter or X yesterday over the weekend were people complaining bitterly about daylight savings time. They think it's the worst thing in the world. Not only did it not bother me, but it's 6:30 here in Connecticut. I'm looking out. It's actually still light out. So I'm the only person in the FinTwit, FinX world who's not cranky today.
Yeah, that's a good thing, I would say. So the bright light. So this week our edition is the Powell just hit the panic button issue. That's a great. I feel like I need a little the red panic button, right, to be hitting when we're going through that. But we're talking Jerome Powell. He recently spoke. We've got jobs reports. Still, Bitcoin obviously continues on its tear in the market. Gold, oil, whole load of information and things to know for this week in investing. Gary, you ready to jump right into it?
We're going to go with Powell. We're going to break glass in case of emergency.
That sounds great.
All
All
right.
right, thing number one, Jerome Powell says the craziest things.
Yeah. So Powell addressed Congress. He does that twice a year. And he is, so for people who don't know, he's the chairman of the Federal Reserve. And in general, he is very calm and controlled in front of an audience. He's good on camera. He's really good at sticking to his talking points. He's always very well prepared. And he does this thing that I always think is hilarious when, reporters have asked him the same question 7 times in a row. He answers and it's calm, but there's something about his tone that's like, you guys are idiots, and I am tired of explaining this to you. But he just does it in a masterful way. That said, so let's go to the details. Powell reiterated his expectation that the next change in the Fed funds rate would be down. The reason that matters, Robb, is because last week we were talking here that, oh my God, we've gotten some economic data that's actually making people say maybe they need to raise rates again. And Powell basically said, no, we're not looking at raising rates. But we are, the next move will be down, but it's going to be later than you think. And it's not going to be 6 reductions. And that's all pretty consistent with what he said before. So that part didn't really take me by surprise.
Question, we referenced, you talk about a 2% inflation rate, right? You look at that, you take that over a 40-year working career. That's about 55% of the value of your savings that would be taken away. When you talk about a 3% inflation rate, you're talking up to 70, 69, 70% of that value being taken away. For you, Gary, and for our listeners, and obviously inflation's been a key primary topic over the last 18, 24 months almost.
Yep.
I mean, what is the best option for them to combat these huge numbers when you look at 55 and 69% of total value being lost over a 40-year working career?
Yeah. So let's talk about what Powell actually said and how it relates to your question, Robb. So the thing that Powell said that surprised me, and I am going to read this because it is a direct
Yeah,
quotation, it's really
I,
important here. He
please
said
do.
he'd consider rate cuts when the Fed has, quote, gained greater confidence that inflation is moving sustainably towards the 2% target. Okay. So there are two things to unpack there. The first one is greater confidence that inflation is moving sustainably. Holy crap, do you realize what he just said? Most people heard, yeah, right, we've got a 2% target for inflation, but that's not what he said. He flat out said they have a willingness, they're looking at lowering interest rates before inflation hits 2% because it's above that right now. And he's basically saying we're not going to stick to this 2% target. We're willing to lower rates ahead of that. And the reason this matters, sorry, everyone, you're about to get a little economic history here. We're going to try to make it not boring, right? But for those of you who are a little bit older, you may remember the horrible, horrible inflation of the 1970s. And for those of you who are younger, you may have read about it. And what happened was that round of inflation actually started in the mid to late 1960s. And the Fed chair at the time was a man named Arthur Burns. And when inflation went up, Burns raised rates to try to get it under control. Inflation started to come down. And Burns let off the accelerator a little too early. He said, oh, well, inflation's coming down. We're heading in the right direction. I think we have it under control. And he started to relax rates, to lower interest rates before we'd hit 2%. And what he ended up with was a re-spike, a spike again in inflation. Burns then got replaced by Paul Volcker, who basically said enough of this nonsense and raised the Fed funds rate. It was close to 20%. I think it was the Treasury bonds were something like 18% at the time, 20%. Killed the economy, killed inflation, got it under control. And one of the reasons why deep knowledge investing has been very much on the hawkish side of things, why we've believed Jerome Powell when he said higher for longer on interest rates, is because I think Volcker is Powell's hero. And I think Powell's biggest fear is being the next Arthur Burns, the guy who let up early and inflation came back and it created a huge disaster. Now, a lot of people right now, particularly political operators, a lot of people in Washington want a higher inflation target. They're saying, well, why can't we target 3 or 4%? And they point to the fact that the 2% target is pretty much random. It was a random number that came out of some, like a European economist basically randomly said this back in the 1980s, 40 years ago. So why do we care, right? This is why we care. First of all, the 2% inflation target is immoral and wrong. The correct and moral rate of inflation is 0. And people say, well, what does 2% matter? It stimulates the economy. It does not. That is 100% not true. People get told that in economics courses, but the logic of that is not sound. We can talk about that at greater length another time. It's a much longer conversation. But the government stealing from you slowly adds up over time. And so the point that Robb was making correctly is, let's talk about a 2% inflation. Most people have about a 40-year working career. Maybe, they're young to mid 20s through their mid 60s or so. And over 40 years, a 2% inflation rate steals 55% of the value of your savings. Now, where does that go? That goes to the government, right? It's called seniorage. It's the fancy economics word for the way the government uses inflation to steal from you. And they do it legally, but it's stealth stealing. They do it in a really quiet way. Well, what if we raise that to 3%? Then instead of 55% of your value, the value of your money being stolen, it's 69%. And by the time you get up to a 4% inflation rate over that time, wait, let me just check my chart here. Yeah, you lose 80% of your money, maybe 79. So these are big changes. And people say, oh, what does 1% matter? Well, compounded over decades, it is an enormous amount of theft by the government. And Powell has spent the last 2 years, as you said, Rob, really holding the line, saying higher for longer. I'm not going to be the next Arthur Burns. I'm going to be the revisitation of Volcker. And he'd been very hawkish in saying, we're going to hold the line until inflation comes down. But there he was in front of Congress he did it quietly, he did it carefully, he did it artfully, but saying moving sustainably. Holy crap, he just said, we're looking at moving the target. And I think the target should be 0. 2%, not great, but we can live with it. You start moving to 3 or 4%, you end up with a lot of government theft.
You mentioned, Powell staying true with the higher for longer mantra. Would there be any political motives here at all? I mean, does Powell move in that way? With him kind of, what seems to me, adjusting course a bit. Now, it obviously hasn't happened yet, but we'll have to monitor that.
Yeah, look, there's definitely a political end to this. Democrats in Congress are really putting pressure on Powell to lower rates now. And they're saying, hey, if we get more inflation, who cares? And the reason is it stimulates the economy. We're in an election year. Nobody wants to run for re-election on a bad economy, on low GDP numbers, on high unemployment. Low interest rates and high inflation will make the nominal numbers look good, and it'll get people raises, and it will make the economy worse long term. But it's sort of like being at a party really late and somebody bringing lots of alcohol in, and everybody gets more drunk, and the party gets more crazy. The problem is you end up really hungover for the rest of the weekend, and it's a bad idea. But you know, if you're running for election at 2 in the morning at that party, bring in more alcohol at 12:30 or 1, right? And that's what they want. Now, for the partisans in the crowd who think that I'm picking on the Democratic Party and think I'm being partisan and taking sides, I will fully acknowledge that President Trump, a Republican president before that, openly lobbied the Federal Reserve and Jerome Powell to lower rates. And what he said was, hey, you guys gave Obama, right? You gave him zero rates and he had GDP growth and low unemployment because of that. Don't treat me any worse. I want candy too.
Right.
Right? Like, don't stop the flow of liquor when it's my party. Right. And so there are political implications for this. There are partisan political implications of this, but I don't, please don't send me messages saying, that I'm picking on the Democrats. They happen to be the ones in Washington right now calling for this. But I freely admit the last time we had a Republican in the White House, he wanted lower rates too. And the truth is, if I were a first-term president and I wanted to get reelected, I'd want lower rates as well. It's a bad idea, but everybody wants the party to be fun when they're the host.
2 a.m. more alcohol. Everybody likes that. The panic button, I think, is hit the next morning when you're waking up. So
there you go. Right. It comes at a price.
Yes. Thing number 2, we're moving to job reporting. Can we trust the new jobs report, Gary?
All right. Well, you know what, Rob? Let's cut to the end on this. It is a deep knowledge investing mantra that if the question is, can we trust the something report, and the something is a government report, the answer is always no. Right? If it's a government report and we're saying, can we trust this? Just start with no. No, we can't. Right? The numbers, they're lies, they're manipulated, and they're also lies. And in case I hadn't mentioned it, they're lies. So we got a ton of economic data out this week. Let's shoot through it. The ADP payroll number was up by 140,000. That was better than last month's number, but below the 150,000 estimate. So that came in weak. That report did show a 5.1% increase in wages. That's a pretty healthy number. The JOLTS report, that's the report that shows how many jobs are available. That one showed openings of 8.9 million. That was below the estimate of 9.3 million. So that came in weak. And then Friday's job growth number of 275,000 crushed the estimate of 198,000 with an asterisk. We'll get to it. But the unemployment rate, rose from 3.7% to 3.9%. So think that through for a minute. More jobs, but more unemployment. We're going to need to go through this. So my question is this bad or worse? That's where we are on this.
You actually stole my question from my notes that I had, Gary.
Sorry.
Was it's all good. As someone, right, and I'm sure a lot of us out there that are not professional investors or, spend the amount of time as you do in these reports, why should I even care? Why should I even look into these? Sounds like everything that you're saying, they're not to be trusted, right? I guess my question for you would be, what value do you get out of it, right? Or what are the pieces that you're taking out of these reports when you are reading through them diligently, as I know you do?
Yeah. So look, it's a great question. Because even though the data is manipulated, and it's manipulated so badly that these numbers, they all get revised. And so one of the patterns that we see is we get these jobs reports showing tons and tons of new jobs. And everyone says, oh my God, this is fantastic. But then the following month, they revise the prior 2 or 3 months, and they always revise them down. And so what we've seen are situations lately where you've had jobs reports that beat expectations, but they revise the prior months down by so much that it's actually a miss. Right? So the number that everyone's paying attention to, it looks like a beat. But when you subtract the revisions from the prior months, in terms of actual jobs, it adds up to a huge miss. So the numbers are dishonest. They always get revised down. And so the question is, why do we look at it? And the reason that I look at it, even though I know the results are lies, is because people will trade off of it. The stock market will move off of it. The Federal Reserve does look at this data. Even though the data is wrong, if I know somebody's using bad data to make a decision, then I want to know what that data says. And that's why I look at it. And there are ways to figure out how manipulated this data is. So, one of the other things worth pointing to is, people say, oh, well, we had fewer jobs available. Yeah, but the key point on this is the reason is wage growth wasn't as much as people had hoped. And as a result, and in addition to that, the market is cooling, the wage market is cooling a little bit, the job market is cooling a little bit, fewer people quit. One of the reasons there were fewer jobs to fill is fewer people quit. And people generally quit when there are lots of opportunities, right? They quit when they can get a better job at another company and get paid more. Once you take that out, well, those jobs don't need to be filled, right? Because they're not moving. So sometimes that JOLTS report, it should be a measure of the jobs available in the economy, but in many cases, it's really a measure of how many people are hopping around. So that's a big part of it right there. The companies don't need to replace those workers. These jobs get revised down, the numbers get revised down. So, there are questions about all this. So the other thing that I'd point out, people will say, well, wait a minute, isn't 275,000 new jobs? Isn't that good? Yeah, it is. But let's talk about what's included in that. So full-time employment is not up. The reason we have stagnant full-time employment, but more people with jobs, there's only one way that happens. You have people taking second and third jobs. It's
Right.
people taking extra part-time jobs. That's not a sign of a great, healthy economy, right? Full-time employment is great. And listen, if you have a part-time job and you go get another part-time job, is that awful? No. But when all of your job growth is part-time growth, that's generally not a sign of a great economy there. And so we're looking at really weaker employment numbers there.
Makes sense. Moving to Bitcoin, prior to the call, we took a look. I think trading right around 72,000 as of Monday afternoon, evening, depending on where you're at. Thing number 3, Bitcoin bears revise their selective memory again.
Yeah. So first of all, congratulations to all the Bitcoin and Bitcoin ETF holders in the audience. We're among you. We've Deep Knowledge Investing has been long Bitcoin in size since 2020 when it was 15,000. We were buying GBTC a year and a half ago at 14 and a half. We were buying it less than a year, but 9 months ago at 18. That closed today around 65. So phenomenal. Today we hit an all-time record above 72,000. Absolutely fantastic. But we're going to talk about the key point that we made last week, which is, listen, I understand why people are bears on Bitcoin. I get it. They don't understand it. They don't trust it. They say it's not backed by anything. I don't agree with that, but I understand why they think it. Okay, fair enough. But what we saw when the ETFs were approved and Bitcoin fell about 10%, these people were crowing on Twitter, on X, see, we told you it's priced in, it's going to zero, you suck, you're terrible. Can I say that on YouTube?
Yeah, we can
All
say
right.
anything.
All
I
right,
think
great.
most anything.
All right, well, whatever. They were super negative and they were crowing. We won this one. You guys are a bunch of idiots. Well, here's what happened. Bitcoin then over the next few weeks ran from then 40,000 up to about 65,000. It's a 72% run. Okay. If you were right on short-term results, then you're wrong on short-term results. If you declare victory on a 16% peak to trough drawdown, then take the L, take the loss when it runs up 72%. We saw the same thing again last week. Bitcoin, at some point last week, it fell 10% in a day. The bears were out celebrating, saying, we're right. You guys suck. You're idiots. Okay, great. But guess what happened? It rose 13%. That was as of Friday. It's up another, I think, $5,000, $6,000 since Friday, which itself, that's more than 10% right there. So that 13% is, probably around 25% from where these people were declaring victory, right? And again, if you're going to declare short-term victory, fine, you're entitled to do that. But when you get a run up in your face short-term of greater than where you were and you're hitting all-time highs, then your hubris, your humility should match your hubris. Come out, admit you were wrong.
Gary, you obviously take a long-term look and approach view of Bitcoin. I know in my circles talking about, okay, taking some Bitcoin off the table now. What would you say to individuals that are trying to get money out of Bitcoin, or if they are doing it? Obviously, a lot of personal decisions go into that, but just your perspective on what you're doing. And I believe it's holding regardless of what Bitcoin's doing over the next short-term period.
Yeah, I'm going to give you my view and put, the usual disclaimer in here. This is not financial advice, right? I'm telling you guys what I think, what I'm doing with my money. You make your own decisions, right? The people listening to this are smart people, right? You're welcome to do what I'm doing. You're welcome to disagree. Put it in the comments. Let me know, right? You agree, you disagree. Just tell me why. I'm interested. Here's my view on this. This is my personal view. It's not financial advice. I think it's silly to have a short-term price target on Bitcoin. I think, it's a volatile asset, whether it runs up or down 10%, 20%. I don't think that means a whole lot. So I don't know what the dollar price of Bitcoin is going to be in a week, a month, a year. Here's what I do know. I do know the purchasing power of the dollar goes down every year. And people will say, no, the dollar's strong. Those are foreign exchange traders. The dollar's strong against the euro, against the pound, against the yen. But if you're an American and you want to buy groceries or fill up your car with gas or pay your rent or, go have an experience, go to a concert, go to a sporting event, prices are up huge. And as Congress continues to run up massive debt, approaching $3 trillion a year right now, every 100 days, we're adding another $1 trillion of debt.
Yeah.
That there's your purchasing power disappearing. So here's the thing. The last time Bitcoin fell from about 65,000 to 15,000, I didn't panic. I didn't go crazy. I just bought more of it, right? Just calm. I bought more. If that happens again, I'm not selling. I'm not panicking. That's, whatever. Now, if and when Bitcoin crosses 100,000, right, goes through the roof, up another 50% from here, I will not be crowing. I'm not going to be criticizing the people who didn't buy it. I understand, it takes a while for people to get accustomed to a new idea, for something that's different. I spent a few years learning about Bitcoin before I took the plunge and bought it. I understand not understanding it. I have grace for those people. And so look, if you're listening to this and you don't own Bitcoin and Bitcoin crosses 100,000, I don't think you're stupid. I don't think you're an idiot. I don't think you're wrong. I also don't think it'll be too late to get involved then. I actually think, so, people talk about the Bitcoin maxis, and for people who aren't conversant with the language used, these are people who own huge amounts of Bitcoin. That, the meme is, somebody sitting in an empty apartment. They have a chair and a mattress, right? They've used all their money for Bitcoin, but they're happy.
Right.
They're happy, right? And so, the Bitcoin maxis tend to annoy some people. I think, saying to people, have fun staying poor it's a terrible way to talk to people. People who disagree with you don't deserve derision. And if you're listening to this and you think I'm wrong for owning Bitcoin, that's fine. You don't deserve derision. It's okay for people to disagree. But I do think the Bitcoin maxis are onto something, despite the fact that they annoy some people. Their mantra, right? That there was that British expression during World War II, keep calm and carry on, right? Whatever happens, we don't panic, keep calm and just carry on, right? And the Bitcoiners have revised that to keep calm and stack sats, meaning no matter what happens, right? Bitcoin gets cut in half, just buy more. Bitcoin gets cut by 80%, keep calm, buy more, right? And a dollar cost average. And I actually think they're correct on this one. I think that's the right approach. I think, crowing that you're right because things move 10% in your direction and then keeping your mouth shut when it moves 70% against you, I think those people lack integrity. And those people should be criticized, right? If you own Bitcoin, keep calm and stack sats. The people who don't, you're not idiots. There's nothing wrong with you, but look into it, right? You might want to have something just even 50 basis points or a 1% position in something outside the dollar, right? Have something that's not tied to the system. And that's my view on it. But whatever you do, as long as you have good reasons for it based on good research, that's fine. I don't think anyone on either side of this is an idiot. I just think we should act with integrity.
Keep calm and stack sats. Very good. Very good stuff. Thing number 4, gold hits an all-time high.
Yeah. So first of all, I'm excited about this too. Deep Knowledge Investing has owned gold since 2020.
Yes, they have.
That has worked out really well, right? We've had huge profits in the name. We have gold hitting an all-time high. That's fantastic. That, again, same thing, right? Gold owners and gold buyers are seeing, wait a minute, the US government is issuing another $3-4 trillion of on-balance sheet debt a year. And as they do that, they're debasing and diluting the existing value of the dollar. The purchasing power is falling. People are realizing that and realizing that gold has been considered the safe haven for thousands of years. There's a reason for it, right? And gold is actually, once we get to the halving, the Bitcoin halving next month, gold will then become, I think, the second hardest form of money, meaning the stock to flow ratio will be the second best after Bitcoin, once Bitcoin gets through the halving. So, I think all of that is fantastic. And, we're certainly enjoying the run up. And I think we understand the reasons. As central banks just issue more and more fiat currency, there's more room for gold to run.
With gold being hedge against inflation, we talk about that a lot of time. Existing listeners, I'm sure, or hopefully are in tune. What about new listeners, Gary? Your preferred vehicle investment for gold? How do you prefer to put your money into gold?
So I think that's a really challenging question, Rob, and it's a smart one. Gold is particularly challenging because there are lots of ways to hold it, and there is no perfect way, right? In an ideal world, you own physical gold in your possession, but the problem with that is you run the risk of getting robbed, right? If you have tons of gold in the house, that may not go well if you get robbed. There are people who bury it in the backyard. Yeah, all right, fine. But also remember in a everything hits the fan scenario, very hard to travel with gold, right? You can own electronic gold. GLD is one option. There are a couple of ETFs that track the price of gold. The issue with that is that money it's in the system. It's electronic money, and it's supposedly backed by metal, but who in the world knows? You put it in a safe deposit box, you run the risk that, your bank gets raided. That happened. There was a bank in California where the FBI came in. They opened every safe deposit box, despite not having a warrant for all of them. And they confiscated everything over $5,000. So if you were an honest tax-paying citizen who just decided to store a few $1,000s of gold in a safe deposit box, they got it stolen from them and had to sue the FBI. It took years to recover. And there was the risk that the government wouldn't give the money back. So the answer to your question, how do you structure this, really depends. But the thing that I want to emphasize, because I think it's really interesting, I think it's curious and interesting that Bitcoin and gold are both hitting all-time highs at the same time. And the reason is Bitcoin is traded as a proxy for global liquidity and risk on investing. When everyone's saying, I want more exposure, I want more risk, they're buying Bitcoin. And, we talked about this before. Lynn Alden has done great charts, tying the price of Bitcoin to global liquidity, basically the global version of M2 for the economists listening to this. For everyone else, basically the more money that governments and central banks and banks are putting into the system, the higher the price of Bitcoin goes. So it's very much a risk on asset. Gold is the opposite. Gold is the gold standard for hedging against inflation, geopolitical chaos, government mismanagement. It's the risk off option. So when you have, Bitcoin hitting all-time highs, there are people who are saying, wait a minute, the governments are throwing tons of liquidity in, or risk on. But if gold is hitting an all-time high with the markets at all-time highs, people are saying, wait a minute, right? Stocks are overvalued. I want to pull money out of the system. I want disaster insurance. It's the ultimate risk off behavior. So we're getting these sort of reinforcing and contradictory signals at the same time. I solve that by owning stocks that I really like, hedging out the equity risk, and owning both gold and Bitcoin, which guess what? We're making huge profits in all of these things. So that's working.
Very interesting. Thing number 5, Gary, we're moving into oil. DKI has a large position in terms of oil, global dynamics influencing oil prices. Thing number 5.
Yeah. So first of all, round of applause for Andrew Brown, the DKI intern who pitched this one. Good for him. Andrew, you're on the board here. Good
Well done,
job.
Andrew.
Yeah, very nice. So we talked about this before, Rob. A few months ago, the Saudi Arabia, they weren't happy with the price of oil.
Right.
And so they decided to reduce oil supply by 1 million barrels per day, because if you're the Saudis, you can do that. Right. And they just said, we're going to put less in the market. Now, people will point out that the global oil market is in the neighborhood of 100 million barrels a day. And they might say, okay, yeah, so the Saudis took 1 million out. Does it really matter? Yeah, it does. And the reason it matters is because oil gets priced at the margin. It's basically the price for the last barrel that determines the market price for this. Okay. Russia followed along. They reduced supply by almost 500,000 barrels per day. Obviously, Russia needs higher oil prices. That's their cash flow. That's their main export. Um, and so what they've done is both these countries have extended their supply cuts, and the price of oil, in this case, we look at Brent crude because it's the international measure, has gone back above $80 a barrel.
You had a conversation recently with Tracy Schuchart, Chai Girl on X. She talked about oil production levels and prices kind of remaining in the same range that they have been, no big breakouts. Knowing your position from an oil standpoint, how do you take that? What does that mean for your portfolio? If you could just elaborate a little bit about that.
Yeah, so Tracy's been right so far. Her comment, and we have it on video. If you look just a few weeks ago, we've got the whole interview with her. It's worth watching.
Yeah, I agree.
Yeah, she's good on this stuff. She's smart, expresses herself well. Really great guest. Loved having her. But her point was, for the rest of the year, she expects oil to trade in a range, a fairly wide range, but basically, she doesn't expect oil to get below the 60 to 65 per barrel um, uh, level on the downside, because if that happens, the U.S. fracking capacity comes offline, you lose supply, and prices come back up. And she doesn't think oil is going to go above $100 a barrel, because above that, you start to affect um, economic factors. Once energy gets really expensive, it's hard for people, and it kills demand. And when that happens, there's less demand for oil, the supply demand curve gets shifted, and prices come back down. So far, she's been right. I think she's got a great point. So I agree with Tracy. The point that she's making is good for another 9 months or so, 9.5 months. She's saying for the rest of the year. Long term, we're bullish on energy prices. I actually like uranium more than oil. We have huge positions in uranium. But basically, when we talk about the electrification of everything, people want electric cars. We are charging tons and tons of devices. You have huge parts of the world, India and China. That's, almost 3 billion people that want a better standard of living. That means more energy usage. All of those things increase demand for energy, and renewables, wind, solar, they're not baseload generation. They're fine for like midday peaking or when the wind
Mhm.
is blowing, but you can't use that for baseload. It's not reliable. And so, I think we're going to be looking at energy prices going up long term, especially given that green activists have made it harder and harder to drill or mine, or transport.
Mhm.
So, long term, they're trying to impair the supply of energy at a point where the world wants more energy. And one of the things people were talking about at the end of last week, right? Everybody's very excited about AI. Do you have any idea how much more energy usage
Hmm.
these data centers require,
Yeah.
right? You're not just talking about running more servers, you're talking about having to power these massive GPUs, and they are energy hogs. And you think, well, you know, how much does it matter? Yeah, but it's a whole data center.
Yeah.
It's not just your desktop at home or your laptop that has a, you know, NVIDIA 4060 graphics card in it. And so at the end of last week, some of the big tech firms were actually saying, if you guys want this great AI powered future, right, what we need is more nuclear energy. And that's hugely bullish, not only for oil, but it's hugely bullish for uranium. Our view is own both.
Right. Yeah, very interesting regarding the AI. I know having conversations about LLMs and the softwares that are out there, right? A lot of them run on ChatGPT, right? Or their open models. The issue with those softwares that are running on top of there is zero price control once those dials get turned up in terms of the cost and computing power. Once demand continues to increase in usage and so forth. So anyone that is building those softwares out, right? The piece and the emphasis on building your own LLM that's not tied, to a lot of these other big LLMs is going to be crucial. So a little bit of a tangent there, but
No, Rob, not only do I think you're right, I actually tried this myself. So the graphics card I have in my computer is powerful enough to run NVIDIA's Chat with RTX. And that's exactly what you talked about. It is an opportunity to run an LLM, a large language model, AI on your own desktop. And the reason that matters is you preserve privacy.
right.
You can let it crawl through your stuff without being connected to the internet, without sending your data and your
Mhm.
information to, Microsoft or Google or whoever you don't want to have it.
Right.
But when this thing was installing itself, it spent 12 hours of a day. My GPU was running at 100%
Yeah.
for hours and hours and hours just to load this thing in. And that was without me using it. That was just to get itself set up. And
Right.
I've communicated on the NVIDIA message boards with other people who are doing this. This is a really common thing. And so imagine, if all of us are doing this, but now try to imagine data centers where you
Yeah.
have thousands and thousands of these things chained and all running at 100% of capacity. Heck, Rob, just the air conditioning alone is going to put a demand on the grid, right? Those
No
things
doubt.
need cooling. You can't run those at what would be room temperature, because that room temperature is going to keep rising as you run it.
No doubt. Don't hit the panic button, but we do have a bonus thing for the Powell just hit the panic button issue. Thing number 6 of this week, bringing you extra value. Or Gary's got a funny joke that I can let you tell if you'd like to.
Go
But
ahead.
the
He's
banking
listening.
system remains sound. Thing 6. Yeah, you could let people know, Gary, the two sides of the coin. Either what is it,
Yeah,
20% more value, or we can't count.
yeah, that's it. Right. So, we said 5 things to know. We give you 6. I don't know. Maybe we didn't count right. Maybe you're getting more value. I don't know. Let us know. If you guys are irritated by getting a 6th thing, let me know. We won't do it again. Anyway, everyone remember a year ago we had a bunch of bank failures,
Oh yeah,
including the second and third largest bank failures in US history. That was fun, right?
very.
Well, guess what? New York Community Bank, which had bought some of those troubled assets. Um, these guys are unsurprisingly located in New York, unsurprisingly have lots of commercial loans, between bad loans on commercial properties, because people don't want to go back to the office, right? Office occupancy in New York, Rob, I think it fell to something like 10% during COVID. I think it's around 50% now, give or take. I don't know. I might not have the numbers exactly right, but
Sure.
you don't want to be in commercial property right now. New York also has destructive rent control laws that make it really hard to rent to people, to renovate places, to keep places nice. There's a recent court decision that was politically based that's driving away property developers, where people are saying, you know what, we don't want to do business here. The property developers that are now leaving the city. And in the middle of all this, the market figured out that New York Community Bank, the ticker's NYCB, has an asset quality problem. And the fear is that we'll see the same thing we saw last year with First Republic, um, and Silicon Valley and a couple others, where people worried about the asset quality, they can pull their money out. And the issue with that is if enough people pull their money out, the only way the bank can give people the money they owe them for their deposits is to sell their bond portfolio. And those bond portfolios, a lot of them, unless their duration is short, are underwater, meaning they're trading at less than 100 cents on the dollar. And now you start recognizing losses, and there goes the equity from the bank. And boy, this is a problem. So that's the chain of events that caused multiple bank failures last year. And last week, a group of investors led by former Treasury Secretary Steve Mnuchin invested $1 billion to keep the bank from failing. And they got the stock to bounce from, God, what was it, about $2.50 to now just below $4.
Right.
So it's still trading at distressed levels, but they're hoping that $1 billion will be enough to bail out the bank and keep them from going under.
Anything your average listener needs to take away from this, Gary, in terms of, okay, having your money in banks? Obviously, there's quite a bit of insurance on, a lot of on these banks with the FDIC and whatnot. Any takeaways, at least for people that are, oh, we see banks failing, right? Like, what does that actually mean for me?
Yeah. Let's talk about that for a second. So first of all, if you have your money in a bank and you have less than $250,000 in that bank, you are insured by the FDIC, the Federal Deposit Insurance Corporation. And, you'll be nervous, but you'll get the money back, right? The government will give you the money back. If you have more than that, there are programs that you can take advantage of where your bank will have a program that will spread your money out. So let's imagine for a minute, instead of 250,000, you had 2.5 million. What the bank will do, if you engage them to do so, is they'll spread your money out to 10 different banks, 10 different accounts. And as crazy as that sounds, doing that, guess what? Now your 2.5 million is federally insured. For people who don't want to deal with that and have more, you can go to Treasury Direct and you can buy treasury bonds. And that, you could lose money against inflation, but you won't lose principal on that. For people who are wondering how to do this, I actually put up a guide on Twitter or X, giving people step-by-step instructions, literally showing you, click this button, red arrows drawn. We made it as simple as possible for people to follow. So there are lots of things that you can do. The other thing that I would add for people who want to know how to interpret this stuff, as all of you know, we are always skeptical of pronouncements by government officials. In this case, Treasury Secretary Janet Yellen, who I'm not a fan of, she's been described by our friends at Unicus as the Marie Antoinette of our inflation. She's constantly reassuring investors that the U.S. banking system remains sound. Despite that, we're still bailing out banks and some of them are still failing. I don't know. Rob, does that seem sound to you? Yeah.
Yeah.
Exactly. Yellen's comments, they remind me of that great scene at the end of Animal House with Kevin Bacon saying, "No one panic. All is well. Everything's fine." Right?
Wow.
As everything goes crazy around him, right? The other thing we linked was that great scene from The Princess Bride, right? Where Vizzini says, this is inconceivable. And Inigo Montoya says, "You keep using that word. I do not think it means what you think it means," right? Every time Janet Yellen says sound, right? The banking system is sound. All I can think is, I don't think that word means what you think it means.
No doubt. No doubt. Well, Gary, thanks again for this week's 5 things or 6 things. Great time going through all the different points. The Powell just hit the panic button issue. As always, thank you for listening, for watching, wherever you may be coming from. Please be sure to subscribe to our YouTube channel. Go to deepknowledgeinvesting.com, grab a free subscription to get updated on the 5 things via email and all the other great things that are happening at Deep Knowledge Investing to pass you the best knowledge, insights of what's happening in the market and what we're doing to make you money regardless of the market, good, bad, indifferent. Gary, as always, thank you for your time and any closing thoughts.
Thanks, Rob. You summed it up beautifully. I have nothing better to add to that. Just for the people watching, thanks so much. We know your time is valuable and we appreciate you spending it with us. Thanks.
Thanks, everyone.